Oh, Manish, great having you as always. Thanks for taking the time
Morning,
out. Crude back to 93. The BOFA fund manager survey suggests that India is the least preferred market and therefore maybe FI flows may stay away. Is it a good time to be constructive for India, or would you be cautious, especially given the fact that there are other factors at play even as the earnings were strong?
So $90 on the crude is the Lakshman Rekha, so on the right hand side of $90, which is 93 and beyond, tends to be slightly a headwind for India into the long term. That being said, I think the numbers are pretty strong. The Q1 numbers which have come out, it's been the best in the last 2 years. And this is not just Nifty or mid cap or small cap. I'm talking all the listed companies basically in NSE. And the median EPS growth is 20% plus. So you can say that it is basically a low base effect. And as we progress into the second half of this year, the base last year would tend to become higher. So the growth rates are going to be slightly lesser. But even otherwise, I think long-term averages on benchmark Nifty 50, like 10-year averages would be 23.5. Today we are 19.5. So everything said and done, the numbers don't suggest a bearishness. So, even if, let's say, the BOFA fund managers say that there is no AI play in India, I mean, it's the best scenario when one should play the contrarian. So I am not bearish at all on the Indian markets. I would, as has always been the case, that numbers do justify themselves over a period of time. And I think this is one such opportunity when numbers and markets are behaving in opposite directions. So I would go with the numbers.
Manish, good morning. Tamanna here. Do you think the newfound or return of enthusiasm for the primary market is also contributing to some of the lack of excitement that we're seeing in secondary markets right now? Because the only place where there seems to be action is in the primary markets. And what are you making of the current crop of listings and companies on offer?
So yeah, I mean, that is a worrisome point. And what is to be monitored is the leverage in the system, particularly in the secondary market. So your margin funding book is now approaching 2 lakh crores. That's a red flag. And because you don't have an option of shorting, etc., primary markets are abuzz with activity, plethora of IPOs. Not that the IPOs are bad. There is enough value in them. But to see a listing gain of 50, 100% on day one, I mean, that has something to do with a lot of, overdoing. So as to say, as far as the fundamentals of companies are concerned, either you price them properly at the time of IPO only, and even after the IPO, if it goes up by 50, 100%, then obviously you are discounting the next 2 years of growth. So I totally agree with you. There is a lot of speculation bubble that is happening, but not to say that the companies are bad. Most of the companies have decent fundamentals, but this pricing action on day one, and there's only that much of liquidity available in the secondary markets. So secondary markets, in spite of very strong numbers, are that money is rotating into the primary market. But all these things do adjust over a period of time. It's not that this is the final word. Over a period of time, fundamentals will take shape, whether for the primary markets or the secondary markets. Listing gains 2, 3, 4 days, 10 days, and then it comes back to normal. So I think, yes, currently there's a bunching of IPO. The pipeline looks very good. And that is something which we are seeing on an ongoing basis. One has to live with that. But that's one of the reasons where there's a lackluster movement. But otherwise, the numbers pretty strong.
Okay. Manish, a couple of pockets which have, on the back of conversations with your brethren, seem to be coming out. One of them seems to be chemicals, and the recent crude drawdown leading to China import not just crude but also raise the prices of certain basic chemicals, and the opinion on what the impact of that could be on global chemical companies, ones which have the product as an output, two which might be using some of those products as inputs, seems to be different. But there is a belief that a select set of chemical names will actually have continued profit, EBITDA, revenue growth, which they have started showing in the last couple of quarters. One, would you agree with that assessment? Why or why not? And if you agree, what are those pockets within chemicals which you believe will have a slightly longer earnings term trajectory in the near term?
So, this Strait of Hormuz disruption being one of the factors. And the second is that manufacturing on an overall basis, ballpark in the Western world, particularly Europe, because of very high costs, is dead. So it's very headwinded. Manufacturing in Europe is very headwinded. And China appreciation of the currency is also a headwind as far as manufacturing cost in China is concerned. And India is getting the benefit of both Europe +1 plus China +1. That is one. But having said that, it's not a blanket rule that all the chemical companies would see a benefit. There would be some segments which are likely to see a benefit. So like, for example, the phenol derivatives, are seeing a massive tailwind. But that is not applicable for all the companies with all the segments. It's a pick and choose. And there are some companies which are seeing a glut. There are some companies which are seeing a shortage. All of this due to supply chain bottlenecks and, stocking, destocking, so on and so forth. So for one, agrochemicals is not seeing any major pull. There's not too much of pull that we are seeing in agrochemicals, or let's say pharma, CDMO, APIs, KSMs, their solvent, these are seeing pushes and pulls. Bulk chemicals, phenol derivatives, etc., seeing a massive pull, and ammonia and all of that. So it's I agree with you that the Strait of Hormuz has created supply chain bottlenecks, but it's specific, it's company specific.
Manish, where are you seeing the pull? That's a very honest question, and one I think that a lot of people are asking right now. What really is moving in any fashion which is showing some excitement? We were having just to add on to it, we were having a conversation earlier in the show today where our analyst was talking about how Indian investors now want delta. They're not satisfied with core fundamentals of a company just chugging along. Are you seeing delta anywhere?
So for one, in terms of segment, the mid and the small cap segment is more euphoric than, let's say, the large cap, whereas there is core value, but core value becomes deeper core value as we speak on an ongoing basis. Having said that, the all pervasive themes have not changed at all. So it's the same enthusiasm regarding your platforms, your capital market stocks, your high-tech, defense, aerospace, precision engineering, semiconductors, robotics, and energy transition. These are some of the, ongoing pervasive themes. And even in the primary segment, you are seeing many companies coming out, nuances. And we are also learning on a day-to-day basis, Acha, this sort of a company also existed. Okay, this is the growth rate. So I think the only piece which is seeing heightened activity is the industrial space, and to do with the investment space where a lot of growth is visible over the next 4 or 5 years. So energy transition, high tech, semiconductor, PLI, and all of these spaces are very buzzing with activity. Pick and choose, logistics, a dark horse, discretionary spend, a dark horse. If you want to believe that, consumption will go through a hyper boom in the next 2-3 years, it's high time that this sort of inactivity in the discretionary consumption space likely to play out. So these are contra plays, but the momentum, the push is basically these 4-5 sectors that I alluded to.
Okay. Manish, the other thing is the ordering activity of late, right? L&T getting large orders overnight. Welspun Corp, of course, it's a very unique thing that it's in the US, but it's a 17,000 crore order, which is large for them. But I'm just saying the ordering activity even from India, Titagarh getting some orders, qualifying for some. There's a lot of ordering activity there, right? Where within this, how do I say, government infra or private capex focused ordering beneficiaries do you find favor? Is it infra players? Is it select capital goods? Is there merit in chasing them?
So yeah, I mean, see, the private capital expenditure has been pretty decent in India. And if you look at even the high frequency indicators, all the high frequency indicators, that is what I'm alluding to, Neeraj. The data which is coming out as far as the high frequency indicators, the corporate earning, seem to not suggest any sort of bearishness.
Agree.
But so in that backdrop, I mean, I'll just give you an example. The total market cap of all the road builders in the country, is anemic at 35-40,000 crores or thereabouts.
But Manish, always been that way, right? I mean, somehow road builders haven't created wealth, na?
No. So basically, NHAI, debt problems, so on and so forth, last 2-3 years. So, now that the leverage factor on the road builders have come down on NHAI as a whole, would you see ordering activity? Yes. If you're alluding to pipe players, the Middle East itself has created such a big, humongous opportunity. You're seeing all these pipe players, get orders from the Middle East per se, oil and gas per se, the build out. And even domestically, the infra capex that is coming through on the energy transition, they are all full of orders. So I would believe that government capex, private capex, in any case, on the energy side, the energy security portion is seeing heightened activity. But I will also allude to the fact that some of the areas like irrigation, or let's say roads, etc. The activities are pretty strong. It's not to say that these should be trading at some anemic multiples. All the pipe companies are trading at ridiculous multiples. So there's a total disconnect between the high frequency indicators, the data set, and what valuations are. So that is why you're seeing all these catch-up trades that are playing out. Always naysayers that these valuations will remain low. But what about the earnings growth? Even if you give the same multiples, the earnings growth is coming through. So that is what you're seeing in the marketplace.
Reckon, Manish, that the AI trade will cool going forward? It already is showing signs of cooling off a bit. At least that extent of frenzy has cooled off. Do you see that cooling further, and that could be an advantage for India?
No. AI trade is not going to die down anytime soon. This whole build out AI frenzy. I mean, India has just not even scratched the surface, whether in terms of the energy requirement. Even if you talk about 2 gigawatts going to 6 gigawatts, I mean, that's a very doable number. Between now and 2030, you will require some 2-3 lakh crores in terms of only energy requirements. And given that where US is in terms of AI build out, I really don't see. You're talking about some $200 billion of anthropic turnover coming through 29-30. So does that justify the upfront investment? I would tend to believe there could be a bit of hiccups here and there, but it's not going to die down anytime soon. The AI build out is real. And, there could be pushes and pulls because of interest rates and all of that, but it's here to stay. I wouldn't believe that this capex is going to come down anytime soon.
Okay, Manish, lovely talking to you as always. Thanks so much for taking the time out and being with us. Look forward to talking to you soon.
Pleasure, as always, Niraj. Thanks.
Thank you. Well, a bit of a stick for the markets, though. I think if I'm not wrong, I saw the index